We still have no more free money as Bank of Japan raises rates to 30-year high, signals more hikes. The Japan yen carry trade unwind. Could it trigger the next market crash? Well, first, take a peek at the chart real quick. We're at what, 1.9% last time we looked at it. Let's go see what it's at right now. Here's your Japan 10-year yield. And you can see we're at, last time I recorded, I think we're right here at 1.977%. Today we are at 2.018. So, if you guys don't understand the yen carry trade, big people like hedge fund managers would go ahead and get free loans at Japan because the interest rate was at zero basically. And then they would just take that money and go buy a US treasury bill and get like 4 or 5% on it. And then they just keep the difference after paying back whatever's charged on the interest rate from Japan, which was basically zero. So when this is drying up like it is right now, that means the world's gonna go ahead and dry up because the money machine Japan is going down. Let's keep going. Bank of England cuts interest rates to 3.75% in pre-Christmas boost for struggling economy. Well, let's also take a peek at this chart. Here's your UK 10-year yield. I tried to find the one that the Bank of England follows for their rates. It just said a lot of things on Google, so I gave up and just came here because this is your inflation indicator. And basically, they're going to do what we might do in January, which is a rate hike. But you can see here, you had a head and shoulders pattern. This one higher than the right shoulder, so no more head and shoulders. And then you broke up, and then now you go up. If you clear the 200, you keep going up. I'm keeping it simple. Let's keep going. So in the last video, we went over how when the Fed purchases a whole bunch of bonds, interest rates go down. So that's usually how it goes. Here, I wanted to give you more of the trade side because I gave you the business reason, I think last week. And this is more of the trade side. So your guys' average percent gain for a savings account is 0.39 to 0.62%. You guys may be like, well, Gordo, that is a really good savings account. I'm like, you could do better than that. Here, if you just go ahead and call up your bank, make sure you're at a big bank, and just say, I want to lock in a 1-month T-bill at 3.56%. So in 1 month, you get 3.56% on your account. So there's that, and then you have all your other years. You have the 2-year, which I haven't flagged because that is what the Fed follows for interest rates. So just gave you guys a little lesson here, what you can do. Remember, this is not financial information, and never follow what a fictional character tells you to do. Let's keep going. As U.S. unemployment rate hits 4-year high of 4.6%. Yikes, you guys are really losing your jobs out there. And if you look here at your job openings total, you guys are going flat here. Remember, every time this chart drops, you get this gray bar. And the gray bar means recession. We dropped. There's no gray bar, which means they haven't called it yet. Should they have called it by now? Maybe. Or maybe we just go even lower. But we will see. You guys also have the unemployment rate, which if you look here at this chart, we are, get close, lower than 2008 right now. 2008 is right here. I'll point it out with the cursor. And we're over here, slowly curling up. I would say we're slightly below. You guys also have inflation unexpectedly slowed in November in what may be a distorted first release since the government shutdown. So we'll see if this inflation really dropped. This is from Fred. This is the consumer price index for all urban consumers. This is just for food and energy. As you can see, should cool off, right? That line's still going straight up, so I don't think we're cooling off. There's also the global markets surge as US inflation thaw ends the data dark age. So, really, there's a inflation thaw. This one's actually a different inflation chart. This is personal consumption expenditures excluding food and energy. This is your personal consumption. You guys are like a little tight on the wallet here, Gordo. It's really pricey out here. Well, yeah, your inflation's still going through the roof. There's also the advanced real retail and all food service sales. So this will just give you a wide view of how sales are going in the US. You can see we kind of just flatlined. We haven't gone down yet. When we go down, you get the nice gray bar of recession. There's also the University of Michigan consumer sentiment. So you guys are not feeling confident out there at all. You guys are like, it's not good, Gordo. It's really not good. Well, yeah, this one's you can really tell is below 2008. 2008 was like over here. We went below. We were even lower a few years ago, and now we're still going lower. But strong economy. So now let's go look at some charts. Here's your 2-year yield. Remember, this is what the Fed follows. This line is not the Fed. This is the 200-day moving average, because you guys know already when you're below that, you go down. But in this case, we went flat. There was a head and shoulders drawn, but because we came down to this right shoulder height, I deleted it because I'm just like, it's just in this pennant now, so not much to do. And it is in a flag. I can draw that out right now for you. There you go. A very, very roughly drawn flag. Pennant. It's just a shape. This is all the market does. But, you either break up or you break down. Have we broken anywhere yet? No, not really. Tried right here. Bounced off of the other support line that goes back a while ago. And just keep going. Here is your 10-year yield. You guys are like, oh, yes, Gordo, we're coming down. Inflation might not happen. Well, I drew out an extended line here. This line right here, this is your neckline of that head and shoulders. You need to break below that to invalidate the head and shoulders pattern. You guys currently sat on it yesterday and today just bounced up. So we will see. And your 200's going flat. When the 200 goes flat, that means you're going through the moon. We have more inflation. And finally, you guys are like, well, main market now. This one is the most reactive to interest rates and all that fun stuff. This is your QQQ, the NASDAQ 100. This is just the tradable symbol. And you guys just came down and then you bounced a little. It's like a little hiccup. You can think of it that way. Because you're still not really bullish on that. And if you look at this other indicator, it's still down. So it says you're still down. And you're above the 200-day moving average. So maybe we bounce off of this line here and then we can hopefully head higher. But it has to break this upper line. And that's just charts. If you guys enjoy this content, make sure to like and subscribe. And next week, we will go over another way to move your money around. Remember, it's not financial advice because I'm just a fictional character. And I will see you guys next week.